This episode of the pod is proudly sponsored by Cadiz Inc. It trades on the Nasdaq under the ticker CDZI. Cadiz is a transformative water resource company that is making a significant impact with its $5 billion in water assets and $173 million in cash. The company is currently constructing a massive water pipeline, the largest in the southwest, which is designed to ensure reliable water access for the region. Cadiz is actively combating the water crisis with game-changing infrastructure projects and strategic partnerships. Under the leadership of visionary CEO Susan Kennedy, who previously served as Chief of Staff to Governor Arnold Schwarzenegger, Cadiz is set to provide innovative solutions and substantial value to both its shareholders and the communities it serves. Always do your own research before making any investment decisions. The information provided here is for informational purposes only and should not be considered financial advice. How are we doing, folks? Welcome to another episode of Stock Club, a podcast brought to you by My Wall Street. I'm Mike, and I want to open up today's show with a thank you to everyone who's listening this year. It's been a great 12 months for the market, for Stock Club, for My Wall Street, our subscribers, and hopefully our listeners too. So we wouldn't be where we are today without your support, even if it is just sticking us on in the background every now and then. So a special thank you and a very Merry Christmas. We're going to be taking the Christmas week off, so you won't see us until the 2nd of January, where myself, Emmett, and Anne-Marie will be previewing our top stories and predictions for 2025. Now on to today's episode. We've been lucky enough to have some amazing guests on the pod throughout the year, and so we wanted to highlight some of our favorites, from exciting Irish founders to old school New York traders. Here's a selection of clips from 2024. Starting out with what might have been my favorite episode we recorded this year. That was my interview with Dan Dicker. So Dan is a Wall Street commodities trader focused on the energy sector, and he's launched his own investment service called the Energy Word. Here he is talking about big tech's newfound demand for electricity thanks to this AI mania we're all going through, and how it'll affect demand for renewables. This was from episode 232, which we recorded back on the 17th of October.
Oh no, I think that these the companies that are going to have these appetites are so ESG focused. They don't want to run this stuff with coal. They won't. If they have to, they have the money and the resources to build the infrastructure themselves, and they will. I mean, look at the deal that Microsoft just did with Constellation. Now, it's a deal that focuses on their nuclear assets. But make no mistake, they went specifically to Constellation because Constellation's growth area isn't 3 Mile Island in Pennsylvania. It's all the renewable infrastructure that they've built out that has been, up till now, the smaller part, obviously, of their utility, but is fast becoming and will become the focus of what they're doing and why they're doing it. I mean, that is the essence of that deal. That is a company that, wanted to buy in and lock in long-term BTUs, mega BTUs for themselves, that were secured and solid and unassailable from either a governmental point of view or a production point of view. I do not see on the horizon an energy shortage reappearing to the degree that it has reappeared itself several times in the past. And one of the reasons for that is because renewable is endlessly scalable. And it requires all anything requires, but it's particularly what renewable requires, is money and will. And AI will drive that will and has the money. I think that AI, and particularly the power centers for AI, are a major factor in the growth of some of these stocks that we're staring at right now, and why I say that this is, why I agree with Fink. This is a multi-year boom that's really in its infancy, really just starting, really needs to be jumped on.
Next up, we have one of Ireland's most exciting founders and most importantly, my Wall Street alum, Shane Curran from Evervault. This is from episode 191, all the way back in January, in which Shane is discussing his top cybersecurity stocks.
The general trend, and going back to this point about there being so many vendors, is that any new company that comes around and they have an amazing new technology that they sell to CISOs, they all get to a point where they have a couple million a year in revenue or whatever. They've proven out that the product works and they have great tech, but they basically end up being bought by these kind of large platform players. Because CISOs are exhausted getting pitches from all these new startups building new tools, they basically just want to have like 2 or 3 go-to vendors that they can buy everything from. And I think the front runner in that for me is this company Palo Alto Networks. There's, from an investment perspective, there's a few things you can consider there, but they're looking like they'll be the first company to $100 billion market cap. I think they're at $75 or $80 billion now, roughly. But they've achieved that by initially having a really good product, and then they just basically layered onto their entire platform every other cool startup. If you look at their press page or their investor relations page, they're acquiring companies every other week, especially now that they're a little bit cheaper because some of these venture-backed businesses are cash-strapped. So they're one that I think will win and are likely to kind of trend towards maybe not $1 trillion company, but certainly between 100 and a trillion somewhere. The other one I really like because they're much more infrastructure focused, and they have a lot of the same functionality from a security perspective, but designed for people who have stuff on the cloud. Because Palo Alto Networks sell a lot to kind of non-cloud companies, but the cloud native company that I really like are Cloudflare. Some great things there, setting aside their product, which like we use, for example, and it's amazing. They've pretty high insider ownership, I think. The founders or the founding team own pretty material chunk, like high single-digit percentage, I think. So I really like them and love the product. And I know you did caveat it by saying publicly listed, but there's this other company called Wiz, who are very new. I think they're the fastest company ever to reach $100 million a year in annual recurring revenue. So still privately listed, $10 billion market cap, which, as we all know in the private markets, doesn't mean a huge amount with the volumes being so low. But they're basically building better versions of all of these different products and then tying them together in a very kind of opinionated way, where if you're kind of the forward-thinking cloud security leader, Wiz are very cool. And I think if they just continue the way they're going, don't buy the IPO, obviously, as we heard a while ago, but when they do go public, give it a couple of years and they should be good.
You'd have done well to follow Shane's advice this year anyways. Extra points for Wiz as well, which, remember, I think we did record it on the podcast. It pulled out of its acquisition with Google in order to go it alone. So we might see that as an IPO in 2025. Next up, we have a clip from our podcast with Mike Singleton from Invictus Research. Mike's a macroeconomic expert who discusses the most important metrics to look for in investing, irrelevant of what you're looking for, according to Mike at least. This is from episode 222 back on the 8th of August.
Stocks or bonds or commodities or currencies or whatever. And that's real growth, inflation, and monetary policy. So if you get those 3 things directionally right, you're going to get a lot of other stuff right as well. Every other data point that we get at Invictus, whether it's consumer confidence or PPI inflation or whatever, any data point, the first thing that we ask is, how does this affect real growth? How does this affect inflation? How does this affect monetary policy? And if the answer is that it doesn't, for example, consumer confidence is a good example of that, doesn't really impact any of those 3 things, then it's just noise, right? Anytime we read a news story and we're like, does this news story matter or does it not matter? That's what we're asking. Does it affect real growth? Does it affect inflation? Or does it affect policy? So hopefully that's good news for your listeners, because that should help distill the signal from the noise when you're evaluating new data or when you're jumping from headline to headline. The way to contextualize all of these things is to ask, does it matter for growth, inflation, and monetary policy? That's the most important framework that I can offer. If you only take away one thing from this interview, hopefully it's that, right? If you get growth, inflation, and monetary policy right, you're going to get a lot of other things right as well. And if whatever you're looking at doesn't affect those 3 things, then it probably doesn't matter.
Next up is our very own Emmett Savage with one of the most prescient stock pitches of the year in episode 215 on the 20th of June. Myself and Emmett were searching for some stocks which we thought would be AI proof. Here's Emmett's pitch for Axon, which would go on to grow about 130% since the pod came out.
Look, Axon is the Apple of the space, plain and simple. And their 20-year market opportunity is off the charts. And anyone who is in the law enforcement business, or indeed civil, like fire brigade and all variations of people who serve the public, they'll have an Axon product on their body in the next 20 years. I'm sure of it.
Okay, easy one there. All right, number 2 reason for owning an Axon.
I think I'll mirror Intuitive's. The second reason I gave for Intuitive Surgical and go with R&D, which led to the launch of the Taser 10 and the Axon Body 4 most recently. And like in the Body 4, for instance, their latest cam, there's a development of a two-way voice communication through the cameras. And their R&D expense was $91 million in the last quarter, which was just 20% of revenue. That's serious. Like, these guys are spending hard to stay in the front edge of what they do.
They need their own team just for acronyms, though, so that's going to cost a lot.
They do, exactly. So exactly. So I think R&D is the second reason. So they are the kingpin in a growing industry is reason number 1, and reason number 2 is they're spending hard to make what they've got better.
And as a company that is leading a market, you love to see that R&D spend, because it's clearly, and similar to what we're talking about with the 2 businesses we've already seen, it's clearly already working.
Yeah, that's right.
You know what I mean?
That's right.
So it's only extending their advantage. Extra points if you caught that one while it was flying. Okay, next up we have Gary Fox from the Entrepreneurial Experiment podcast. He's telling us all about what he's learned from his work with founders and how they work and operate in their daily lives and even outside of their work. So this is a clip from episode 217 that came out on 4th of July.
It's interesting, like they're definitely 2 different things, right? People think, oh, it's just they're good at business to be good at finance. And you know this, often they're not. They're not very good at finance. They're good at making it, but they mightn't be good at like deploying it or even spending it. So there's definitely 2 different things. It's very important to kind of realize that.
It's so like, true.
People like you who are experts in finance, that is very, very different than the guys who are really good at like business. Like that's their silo, that's their niche. What's their superpower? You know, it's making money, and that could be within a certain industry or whatever it is. Like, just because I think it's important to realize what you're good at and what you're not good at. And I think a lot of good business people, the great ones I meet, are super open about their weaknesses, and they go, nope, don't know anything about that. And I love when people go, I don't know, Gary. I don't know the answer to that. That's not my strength, because then they're truly self-aware as to their strengths, and they just hire people. They go, okay, I need Emmett for this, I need Gary for that, I need John for this, I need Sarah for that. Great, I'm going to be over here doing what I do best. I had Gary Lavin last week. I chatted to him. It's not out yet, but it'll be out in a few weeks. And he was really self-aware. He took on a new CEO and stood aside. And like, the lack of ego that takes is big, because most people want to be CEO. They even just want the title. Like, I know people that just get off on the title alone. It's the lack of like ego is huge in the really good people. They're like, I don't really care what you call me. And like, sometimes I'll have people, and I check the details like you do, you know this yourself, going, just get your title correct. What's your title? Founder, co-founder? They're like, I don't care. Call me whatever. Yeah, founder, fine, whatever. You know, it's that's not what they're doing it for. Whereas you see a lot of aspiring entrepreneurs, and they just want the title. They want the CEO title on LinkedIn or Instagram, and it's kind of like, that's not what it's about. It doesn't really matter what you call you. The work is the same. So it's important to kind of know, to go back to your answer question about what traits do they have. They're just really good at knowing what they're not good at. That's what I really have noticed, in that they're really good at knowing what they're not good at, and they're not afraid to hide it. And as I've gone through this journey with the podcast, I've become far more open about myself and just what I feel. I'll be very open about everything that I'm doing, because I don't feel like I need to pretend, because I've realized that the good ones don't need to pretend. You don't need to project.
For this next clip, we're going to go back to our old mate Dan Dicker, who's talking about the advantages retail traders have over institutional money, a topic close to our heart here at My Wall Street. I had to include 2 clips of Dan, because I could listen to this fella read the phone book in that accent. Here's Dan.
You know, it requires some patience, but, I deal with a special kind of investor. I don't deal with day traders. I've been a day trader. I know what it means to be a day trader. It's hard. And believe me, you need something besides, just sitting behind a desk, being, really diligent with what prints are going across the screen in order to make money as a day trader. Your edges will come from being, honestly, most of your edges will come from being a small retail trader as opposed to being an institutional trader. And again, I talk about that with my clients, with my subscribers all the
Oh,
time.
absolutely.
And
Something
also
we say as well.
in having the patience.
It's
What's
something to
that?
say my Wall Street as well. There's so many advantages to, not having any quarterly reports, not having any expected demands. You can buy and hold. You can sit there for 10 years and not do
Not
anything with
having,
it.
how about having volume requirements?
Absolutely.
I got to push out 300,000 shares of this crap, next month because whatever is coming due, and the liquidity is just not there to deal with it. If you're a retail guy and you've got 600 shares, which for you is a big position, hey, the market looks at you and they smile. Whatever you want. You're not gonna hurt a market. You're not gonna touch it. Just that ability to move into low liquidity markets, in and out of low liquidity markets. Commercial traders can't do that. Professional traders can't do that. Only small retail traders can do that. Can say, I'm willing to do these options here, and I'm only willing to do these there. And you put orders in. If they go off, great. If they don't, put them back in tomorrow. You'd be amazed how many times they go off. You're going to get off 10 options where that wouldn't make a dent. It wouldn't even start. The computers running at a family shop, much less a hedge fund guy. But for you, it could mean the world. It could mean a $12,000 or $14,000 trade over a couple of months. That's something a retail guy can do. That's not something that an institutional guy can do. So there's lots of again, I talk about this with my subscribers all the time. There are plenty of advantages to being a retail guy. One of the disadvantages of being a retail guy is trying to duke it out with the algorithmic people on a day-to-day basis. You're gonna die. I don't know when, but you're gonna die.
Yeah.
And I can basically guarantee it. So don't do that.
All right, next up is yours truly. Here's a clip from episode 235 that came out at the start of November. I've included it because I believe it's an important type of stock we should be more open to, especially as Irish investors and the issues we have with foreign ETFs and all the rest and indexing. So hopefully this clip explains what I'm on about a bit better than what I'm trying to do here.
Right, Mike, hit me. Which stock did you pick from Nexus One that you think is going to grow? Potential to grow at least 10x from today's levels.
Yeah. So I'm going to preface this by piggybacking on what you said about Sweden, the investing culture there. And not only does it lend itself to building great public companies, but it also lends itself to building great stocks. And what I mean by that is that there are these particular type of company, a holding company or conglomerate or a serial acquirer, whichever way you want to kind of call it. But basically, these are really incredibly investor friendly stocks, essentially because they're run by investors. So Berkshire Hathaway is the obvious example. Warren Buffett is arguably the greatest investor we've ever seen, and he's laid out a blueprint for so many companies to follow in that same shape or form in one way or another. And then when you look at the top companies by market cap in Sweden, an awful lot of them fit into that shape or mold. So if you just look at Investor AB, Indutrade, AdTech, Lagerkrantz, Technion, which is a much smaller market cap than the rest, but it will hopefully get up to that stage at some point. And then the one we're talking about today, which is Lifco or Lifco AB, which you'll probably see it, but AB is kind of like LTD or CO in Sweden, basically. Now, why I think this is a particularly relevant area of the market, especially for Irish investors listening in, is that we've talked about how punitive it is tax-wise to become an index investor, basically, in this country. Instead of buying ETFs, why not look at individual stocks that own portfolios of companies? So instead of trying to get that diversification from one index, you're getting it from an individual stock that is taxed in such a manner, but also owns, like Lifco owns over 200 companies. Now, they're not going to be as obviously diversified as the S&P 500, but there's enough variance in, say, Berkshire's holdings or Investor AB's holdings to act in lieu of an index. And then you can get more granular. You can look at a company like Danaher for biotech exposure, Lifco for industrials, Constellation Software for software, obviously. But the list goes on. And I think in my view, it's a handy workaround for a very annoying problem we have here in Ireland. If you isolate a couple of these conglomerates, and maybe if you just want to recreate the S&P 500 performance, add in the Magnificent Seven on top of that, I don't think you're going to be too far away in terms of tracking this. Obviously, it's not going to be word for word, but it takes away a bit of the stress of individual stock investing by knowing that if you buy one stock, you're actually holding hundreds of companies. Okie doke. Next up, we have a voice which I'd say everyone knows at this stage. He's our favorite electric vehicle expert, and that's Nevo's Derek Riley. He's been on the show. I think this was his third time on the show. Here's Derek talking about pick and shovel plays in the electric vehicle industry. This was from our episode back in January, episode 194 back in January. This is Derek Riley.
And it's very much like you're saying, that the lithium and that whole mineral side of things. I know we don't talk about it much on the podcast, but because it's an interesting, but also one that you need to be conscious of, that lithium is the buzzword at the moment, but it could change to sodium next week. And sodium ion batteries could be the ones that are going to be the next for the next 10 years. So the chemical and the raw materials will want to be careful of, because it is one that could pivot very quickly and can change very quickly. But the next step up the food chain with regards to the hardware manufacturer of the charging infrastructure. And so, for example, there's an Australian company called Tritium. They're on the US Stock Exchange. A lot of these EV manufacturers and EV related companies would have had the Tesla effect. Oh, it's EV, people jump into it, and I think that's what happened with Polestar. It's an EV stock, we're going to get in quick because we can see what happened over there with Tesla. So you the likes of Tritium.
This actually happened with Harley Davidson. They spun off their electric
Livewire.
Yeah, just it's Harley Davidson, but they're like, we want an EV valuation, so it's a separate company.
Yeah, and that's what happened. And a lot of that was SPAC as well, you know what I mean? And crazy stuff, like absolutely crazy stuff. But like the likes of Tritium, but look at where the cars are going to be charged. So Tritium do fast DC charging, so it would be motorways, public places, etc., etc. But then look at those organizations and manufacturers of home charging units, the likes of Wallbox, etc., etc. And they're a Spanish company, but again, last year were advertising on the Super Bowl, because everybody who buys an EV usually will put a charger on their house as well. These chargers have a 3 or 4 year lifespan, maybe 5 years, and then they're changing them around again. Not cheap. In Ireland, we get government subsidies, but they're also getting smarter and smarter as a piece of hardware, piece of tech.
Yeah.
And then you have the likes of heat exchange units, air to heat units that are putting chargers into the unit as well, because it's a high energy piece of equipment, but also so is a home charger for your car. And there's an Irish company that's looking at that and combining the two of them. So that technology piece, and I suppose that's why I got into it originally, and that's why I'm just back from CES, that consumer electronic side of things. And where would you invest? As you said, it's not just the OEMs. Look at the macro. Look at where can somebody charge? What industries are in there? What market? What companies are on the market that are producing the hardware? That's producing the technology. Wireless charging is something else that is starting to pick up a bit of momentum. And so there's a company called Witricity and others. And I'm dropping a couple of names here, but start doing your research and you'll start to find where these startups or more established companies are in that charging space, manufacturer of battery space, etc.
Next up, we have a clip from episode 206 back in April, where Emmett and I got to chat to the co-founders of the private investments company Shuttle. You might have known it as Pitched It before it rebranded later in the year. So that's Scott Ashmore and Rob Halligan. Here they are discussing one of the tacit advantages of private equity investments over public shares.
You know, there are risks obviously associated as well. People need to be aware of that are quite different to public market assets. There is a capital lockup, right? There is the illiquidity issue there as well for the large part. You can expect that your investment is going to be, or your money is going to be invested for quite a long period. You can't just get in and out like you can in the public market. So that's obviously something that people need to be aware of going in.
It's probably promoting good traits, good investing traits, though, isn't it? Like this, we always preach a buy long-term, buy and hold strategy, but it's a lot more difficult to do when you go and turn around and see one bad news story and sell it in the morning. You can't do that with private investments.
No, you can't. So I think you see a bad news story and it obviously triggers people to start panicking, and then that's you see everyone selling. That can't happen. So like it or not, your money is going to be locked up for likely a considerable period.
You'd want to be fairly zen, all right.
Yeah. Well, whether you are or you aren't, once you're in, you have no choice anyway. So I guess you're just going to have to deal with it.
Okay, last but certainly not least, we're closing out the show with a clip from episode 197 back in February, which is actually even more appropriate now than it was then, where me and Emmett are discussing investing at all-time highs, which we've ended on a good one. I think we saw nearly 60 all-time highs over the course of 2024. So this is a very appropriate clip for now, but you can go back and listen to that episode. I think it's February 14th or 15th it came out. And it seems very counterintuitive. It's from research from JP Morgan, and they found that if you invested in the S&P 500 on any given day since 1988, your average return a year later would have been 12%. However, if you invested on days where the S&P 500 closed at an all-time high, your average return would have been nearly 15%. So that extrapolates further out. 3 years is 39% and 50%. 5 years, it kind of gets a bit closer again at 71 and 79. So it has less of a long-term effect, we'll say. But as someone who's been through so much market turmoil in your career as an investor, what are your thoughts on investing at all-time highs? Does it give you pause as a stock picker?
Well, that information is useful for sure. Like, especially if you're an index investor, it really is useful information. And I'm not an index investor. And there's a lot of virtues to being just an index investor. It takes away an awful lot of the variables.
An awful lot of the stress too, I imagine.
And a lot of the stress, but a lot of the enjoyment. Depends on what you're after. But what we're trying, if you're trying to codify what you just said into a system, you can look at the data, and in the last 12 months, as of today, which is Valentine's Day, February 14, 2024, there's been 3 all-time highs in the S&P 500, with the most recent one being January 29th. When we look at the last 5 years, up until today, there's been 41 all-time highs for the S&P 500. If we widen our view a little bit more to 10 years, there's been 86 all-time highs, and over 20 years, there's been 240 all-time highs reached by the S&P 500. So if we were to take the last data point, which is 240 highs over 20 years, that's 240 months. That's a very clear average of about 1 high per month. But as we know, it's anything but spaced out evenly. You could get 5 new all-time highs in a week and none for a year. But to my point, you could put an equal amount of cash aside per month, and when you see a new all-time high, put it into the S&P 500, everything you've saved up, and start all over again. Start saving till you hear the next all-time high. But it doesn't give me pause. It certainly challenges logic that buying anything at an all-time high is bad. In fact, past price appreciation is always a good thing, and has been proven a million times across life and nature. The strong get stronger and all that stuff. So I do think that if the question is, does it give me pause as a stock investor or a stock picker? It doesn't. It allows me to, I suppose, get confident in businesses that have had a run recently.
Right, that's it. As Bill Hurley would say, okie doke, we'll leave it there. So once again, a big thank you to all the guests throughout the year who managed to come on and make Stock Club a little bit better, so you weren't bored out of your minds listening to me and Emmet and Emery chat week in, week out, change it up a small bit. But most importantly, thank you to every one of you listeners for just making 2024 a really, really good year for everyone. Let's hope 2025 can match it. And that's it. We'll talk to you next year.